For the last 3 decades, the advice has been almost ceremonial. Invest consistently, earn average returns, retire comfortably. The formula feels mathematically airtight. Put $1,000 a month into a broad index fund earning 8% annually, let compounding do its work, and in 30 years, you should have roughly $1.5 million. The spreadsheet confirms it, the historical averages support it. Advisors repeat it because, statistically, it works. The market trends upward over long periods. Time smooths volatility. Case closed. That's the shared belief system of the modern professional class. But when you zoom in on actual wealth timelines instead of averages, something unusual appears. 2 investors both contribute $1,000 per month into the same index fund earning 8%. They start at the same time, same discipline, same returns. After 9 years, they each have contributed $108,000 and accumulated roughly $155,000. Nothing dramatic. Then, one investor stops. The other continues for 6 more years. By year 15, the second investor has around $350,000. The first remains near $155,000. The gap isn't incremental, it's exponential, and the divergence happens late, not early. Here's the unsettling reality most people never internalize. The majority of lifetime returns are earned in a narrow window near the end of the timeline. Compounding is backloaded. In the first 5 years at 8%, growth feels almost cosmetic. Years 6 through 8 feel frustrating because contributions still dominate returns. But after year 10, the portfolio begins generating returns that rival or exceed annual deposits. By year 13, 14, 15, the curve bends upward aggressively. If you stop at year 9, you never experience the phase where capital begins working harder than you do. We're told wealth grows steadily, like a straight line moving upward. But the lived experience is different. Years 1 to 5 feel stagnant. You might contribute $60,000 and see only $10,000 or $15,000 in gains. It feels inefficient. Years 6 through 8 feel discouraging because market volatility can wipe out a year of returns in a quarter. Years 9 through 12 start to feel promising. Then years 13 through 15 feel almost unfair in how quickly net worth expands. That's not linear growth, it's delayed acceleration. And if you don't understand delay, you misdiagnose the system. The first phase of a 15-year wealth cycle is about capital density, not performance. If you're earning $120,000 per year and saving 20%, you're investing $24,000 annually. In the early years, that contribution is the engine. Returns are small relative to deposits. Your savings rate, not your asset allocation, drives the outcome. Motivation is lowest here because feedback is minimal. Lifestyle creep becomes tempting. Upgrading the apartment, financing a new car at 6%, increasing fixed expenses by $1,000 per month, these choices feel harmless, but they reduce capital mass during the only phase where mass matters most. Most mistakes in this early stage are behavioral, not technical. Contribution inconsistency destroys the curve. Pausing investments during downturns because the market dropped 20% resets momentum. Performance chasing, moving from diversified index funds into last year's best-performing sector, introduces friction. The portfolio might be $80,000 or $120,000, which feels small compared to your income, so you underestimate its future leverage. But this phase isn't about momentum, it's about building gravitational force. You're pouring concrete, not decorating a skyscraper. If you weaken the foundation, the upper floors never get built. The second phase begins when returns start competing with contributions. Around year 8 to 10, an 8% return on $250,000 generates $20,000 per year. If you're contributing $24,000 annually, the portfolio is almost self-reinforcing. Volatility feels meaningful now. A 10% correction erases $25,000 on paper, which suddenly feels real. Emotional attachment increases. You check balances more often. Confidence grows because the numbers look substantial. This is where overconfidence quietly enters. Investors begin concentrating into hot assets, increasing risk exposure, or trying to accelerate the timeline through leverage. This middle stage rewards discipline, not aggression. The temptation is to optimize by chasing higher returns, moving from a diversified 8% strategy to speculative assets promising 15%. But risk-adjusted returns matter more than raw returns. A single 40% drawdown requires a 67% recovery just to break even. When capital reaches $300,000 or $400,000, preservation of trajectory becomes more important than speed. The system is finally working. Interfering with it for incremental gains often introduces non-linear downside. The goal is not to win this year, it's to protect the curve for the final phase. The third phase is where compounding dominates. At $500,000 earning 8%, the portfolio generates $40,000 per year. At $800,000, it generates $64,000. Monthly contributions start to matter less relative to market growth. A single strong year in the market can add more than your annual salary. Wealth growth begins to detach from labor. This is where identity shifts from earner to capital allocator. You're no longer just converting labor into income, you're deploying capital into optionality. But the danger here is interruption, large withdrawals, panic selling during recessions, or attempting to time market cycles. There are three forces that quietly flatten this 15-year curve. High fees are the first. An expense ratio difference between 0.2% and 1.2% sounds minor, but over 15 years on a $500,000 portfolio earning 8%, that 1% drag can cost well over $100,000. Emotional withdrawals are the second. Selling during a 30% downturn and re-entering late permanently reduces compounding power. Timeline resets are the third. Starting over repeatedly, liquidating to fund lifestyle upgrades or speculative ventures destroys accumulated mass. Small friction compounds negatively just as powerfully as positive returns compound positively. Wealth, in practice, is not built by intelligence. Most professionals already understand diversification, inflation, and long-term averages. It's built by endurance through delayed feedback. The early years test patience. The middle years test ego. The final years test restraint. The 8-4-3 cycle feels backwards because the visible rewards arrive late. The curve hides its steepest slope until most people have already stepped off. So the real question isn't what return you're earning, it's whether you will remain long enough, consistent enough, and disciplined enough for the shape of growth to change in your favor.
Let's be honest, if you invest consistently for 7 years and your portfolio still doesn't feel life-changing, it looks like the strategy failed. You followed the rules. You automated contributions, you skipped lifestyle upgrades. Maybe you invested $1,500 a month, roughly $18,000 per year. After 7 years, you've contributed $126,000. At an 8% annual return, your portfolio might sit around $165,000 to $175,000, depending on timing. That means your total gain is maybe $40,000 to $50,000. Spread over 7 years, that feels underwhelming. You sacrificed optional consumption for what appears to be modest progress. The emotional math doesn't match the financial math, and the surface story becomes simple. This isn't working. But extend that same timeline just a few more years and something unusual happens. Keep contributing the same $1,500 per month. Don't change funds, don't increase risk, just continue. By year 10, you might be near $260,000. By year 12, perhaps $350,000. By year 15, you're approaching $500,000. The jump from year 7 to year 15 is not incremental, it's disproportionate. Same contribution, same average return, entirely different trajectory. The effort didn't change, the discipline didn't change, the timeline changed. So the real anomaly isn't the slow start, it's the late acceleration. Progress hides itself early because the system is not designed to reward participation immediately. Compounding does not reward effort, it rewards survival. The first several years are structurally dominated by your contributions, not by market returns. If you have $100,000 invested and the market earns 8%, that's $8,000 in growth. If you're earning $120,000 per year from your job, $8,000 feels minor. Your labor income dwarfs your capital income, so your brain dismisses it. But once your portfolio reaches $400,000, that same 8% generates $32,000 annually. At $700,000, it generates $56,000. The system withholds visible impact until capital mass reaches a threshold. Most investors never cross that threshold because they interpret the early silence as failure. We're trained to expect hard work to produce quick, measurable progress. Study harder, get better grades. Work more hours, earn more money. In most domains, effort correlates tightly with outcome. Investing reverses that relationship. You exert disciplined effort for years, and the visible expansion is delayed. Long invisible input leads to non-linear output later. That inversion psychologically destabilizes people. They begin comparing their $170,000 portfolio to someone else's new luxury car. The car produces immediate sensory reward. The portfolio produces deferred optionality. One feels tangible, the other feels abstract. Without a clear mental model, delayed gratification starts to look like self-denial. The early years create a specific emotional tension. You feel disciplined but unrewarded. The ratio of contribution to return explains why. In year 3, perhaps you've contributed $54,000 and earned $6,000 in gains. 90% of your portfolio is just your own money recycled. It doesn't feel like leverage, it feels like storage. Meanwhile, upgrading your apartment by $800 per month produces instant lifestyle enhancement. From a cash flow perspective, that $800 could have compounded at 8% for 20 years into roughly $460,000. But in the short term, the nicer space feels more rational. Early investing builds infrastructure, not visible wealth. It's like laying fiber optic cable underground. No one applauds buried cables. Around years 8 to 10, a tipping threshold begins to emerge. Your portfolio might cross $250,000 or $300,000. At that level, an 8% return generates $20,000 to $24,000 annually. Now returns are stacking meaningfully on top of returns. This is the return on return effect becoming visible. Dollar volatility increases too. A 5% monthly swing could move your net worth by $15,000. That feels significant. For the first time, capital income starts to resemble a secondary salary. Psychologically, this is validating. The years of quiet discipline appear justified. But a new danger emerges here. People begin attributing the acceleration to intelligence instead of patience. When investors misinterpret compounding as personal skill, risk tolerance expands. They concentrate into hotter assets, increase leverage, or attempt to optimize what was already working. The irony is that the tipping threshold rewards consistency, not brilliance. The math didn't change because you became smarter. It changed because the base grew larger. Acceleration is a structural feature of exponential growth, not evidence of forecasting ability. If you interfere aggressively at this stage, you risk disrupting the very mechanism that created the momentum. The system is finally compounding efficiently. Your job is to protect trajectory, not outperform it. Acceleration compression is the part few people understand. It may take 8 years to build the first $200,000. It might take 4 more years to add the next $200,000. Then perhaps only 3 additional years to add another $200,000. The timeline compresses while output expands. Wealth density increases over time because each dollar now produces additional dollars. The growth of $100,000 on a $100,000 base requires 100% return. On $1 million base, it requires only 10%. The effort required to generate meaningful net worth changes decreases as capital mass increases. That's why the back half of a compounding cycle feels dramatically different from the front half. Several structural threats can kill this acceleration. Fee drag is the quietest. Paying 1.5% in total fees instead of 0.2% might not feel meaningful annually, but over 20 years on a $500,000 portfolio earning 8%, that difference can reduce final value by well over $200,000. Panic during market crashes is another threat. Selling after a 30% decline locks in loss and forfeits the rebound, which historically accounts for a significant portion of long-term returns. Interruptions for consumption, liquidating investments for depreciating assets, reset the base. The most destructive pattern is restarting from zero multiple times. Each reset destroys accumulated density and pushes escape velocity further away. The early years are not proof the strategy failed. They are proof you haven't reached escape velocity. In physics, a rocket burns most of its fuel before leaving the atmosphere. The heaviest resistance exists at the beginning. Investing operates similarly. Your early contributions are breaking through psychological gravity. The visible reward arrives later because exponential systems hide their steepest slope near the end. Investing is not about being right in any single year. It's about staying in the system long enough for mathematics to dominate emotion. The real question is simple. What year are you currently in, and are you about to quit right before the curve changes shape?